When we think of investing, it means simply allocating capital to achieve the best possible outcome. But when it comes to pensions, this process is strategic, it's governed by a board, it's built on systems that have to serve millions of end users and typically very old. That makes the process complex and limited, as you can only access the opportunities that are enabled by your infrastructure. This episode is about how technology enables investment innovation in order to deliver better outcomes for investors. And I'll be speaking with James Lawrence, Director of Investment Proposition at Smart Pension. James, thanks so much for joining me.
Thank you. Thanks for having me. Really interesting times.
Indeed. And we're going to get into your role and all that, but we're recording on the 23rd of April. Markets are up 3%. I think they were probably down 3% yesterday. It's a particularly volatile time. So can we just start by having your approach as a Director of Investment Proposition to this everyday market turmoil?
Sure. And as you say, my Bloomberg screen is flashing all sorts of different colors every 5 minutes. So we don't know where we are at the moment with markets. Yeah, I mean, we're a pension scheme, right? So we always have to keep focused on that long-term investment goal. And that's 30, 40 years plus. But that's easier said than done, particularly when, we're a tech provider. Pensions are in your pockets these days and you can check your pension balance every day. So for us, it's really about building resilience and through things like private markets, diversification, all the usual stuff that everyone listening to this podcast will think about when building up portfolios for times like these. But importantly as well, it's about putting this into perspective for everyone. So, we've got 1.5 million members, some very investment literate, some that are very new to investing or don't fully understand how it works. And they see, a few £1,000s has come off their pension. For us, it's about reiterating the long-term focus, putting things into perspective, showing them graphs that are 3-5 years with a small dip right now, rather than 3 months, 6 months graphs, which show, cliff edge type investment performance for some strategies. So yeah, it's about keeping on top of performance, being super proactive and building that resiliency into our portfolios and doing what we can do.
Yeah, and also I appreciate your role as you've come up with a video basically explaining all that. And that's also kind of I think, a different approach to pension. I don't know if all your 1.5 million users will see the video, but hopefully quite a few, but putting a face to it and make it more personable, more relatable. And I think that's also an important aspect, right, of the new landscape of pensions.
Yeah, I mean, for years in pensions, we've been really pushing hard to engage members. And that's been at a really fortunate time for markets that have generally gone up pretty strongly. And obviously there's been some dips in the past few years as well, but we've not really seen it like we've seen recently, the volatility that comes with its downfalls. So when you engage people, they see their pension value falling sharply at points as well. So they can make decisions that might not be best for them in the longer term. So yeah, the landscape's rapidly changing in pensions. It's moving massively away from being something you don't think about for 40 years until you retire, and then you sail off into the sunset with your pension, to something that's more akin to a lifetime of savings that's in your pocket, and something that you think more about like an ISA or a long-term savings vehicle that you need to think about and make sure you're contributing enough to and investing in the right way. So yeah, lots of work to be done in the new landscape for pensions, and some good and some bad bits to that.
So we're going to go back to that, what you're doing in terms of investment and investment proposition and your different funds. But first, I'd like to understand, your background and your control. So I see that you were working at Mercer, which is a big pension consultancy, and now you're Director of Investment Proposition, which I guess is a very similar title to Chief Investment Officer. But can you clarify, the Mercer experience and how it led into your role?
Yeah, of course. So I've been in the industry for about 13 years now. Started off my career in Mercer, really focused on investment consulting back then. So providing advice to big pension funds, multi-billion pound pension schemes on how to best invest their savings for the longer term. Moved roles slightly in that time to something that focused more on the OCIO, so they kind of outsourced chief investment role at Mercer instead of building it as part of pension funds themselves, actually building the funds and the solutions for them and moving into that space. And yeah, left Mercer about nearly 4 years ago now, moved from a large global consulting behemoth to a much smaller fintech, but one that's growing rapidly and disrupting the pensions world, not just by providing a pension scheme, but providing that technology as well. A very different type of place to work, but good experiences really. And as you say, similar to a CIO type role here at Smart, building investment portfolios, managing stakeholders, ensuring everything is running well from an investment's perspective.
But so that we understand clearly, it seems there's a lot of players in this pension ecosystem, right? So there's the role of consultant, there's trustees, then you work for many companies that on board with a smart pension, but ultimately for the pensioners. So can you give us an overview of this particular ecosystem around what surrounds the investment decision and allocation?
Sure. Yeah, it's a really interesting question. It's a very long value chain in pensions, which complicates things sometimes. So ultimately, our end user is a member. So everybody who works for a company and is investing into a pension scheme is our end client. They don't tend to pick their pension funds, not least currently in the UK. It tends to be the employer that picks the pension fund for them. So they're our main client base is the employers. They'll go to market and find pension schemes. There's people like us and Nest and whoever's offering pension funds in the UK. A lot of the times they're not pension experts. Some of the bigger companies, they've got deep resources in this space, but a lot of the people making those decisions are HR focused people or finance directors, those types, which if they've got some pension knowledge, but not deep technical pension knowledge. So they will use consultants to kind of broker those relationships. So a lot of the work we do is talking to consultants about our offering and why we're different and returns and all that kind of good stuff as well. So consultants have a big part to play in the ecosystem at the moment. And as you say as well, trustees. So we're ultimately governed by a trustee board. They're an independent set of trustees, not affiliated to Smart, all with different experiences. In our case, in particular, so management consultants, comms consultants, investment specialists, pension specialists, etc. So they're the ones who make the ultimate decisions. And we at Smart, as the provider, will go to them with ideas and thoughts and changes. And they're the ones who have to sign it off. So yeah, quite deep ecosystem. The government's looking to change a lot of that at the moment, particularly in things like consultant space, starting to potentially regulate that space a bit more and increase the governance that they need to undertake, and also reduce the number of pension providers as well, both in the kind of local government side of things where they're going really hard and there's already been some big announcements on some mergers, but also in our space, making the number of pension providers much smaller and bigger.
This is a very interesting topic, but before we get back to that, I would like to dig a bit further into this trustee relationship. So I understand that there's multiple funds. How exactly does it work in terms of, you said that the trustees take the decision, but they don't run it on a daily basis. So what is this decision? Is it about the asset allocation, the overall strategy that you have to implement?
Correct. Yeah. So the trustees on the trustee board have ultimate fiduciary responsibility for our 1.5 million savers. So what that means in reality is they can't do everything. They can't do the day to day. That's why we have an in-house investments function, which I lead here at Smart. What it means is they set the asset allocation. They make sure that we've got the right level of risk. We've got the right processes, controls, governance in place to make sure we do that on a daily basis. They'll pick managers with us as well. So we'll go to them with kind of shortlisted managers, but they'll then present to the trustee board, and the managers will choose who they want to go forwards. They'll review managers on a regular basis, hire, fire, that kind of stuff, again with our input. But yeah, they're doing the big picture stuff, but also making sure that everything day to day is running smoothly and there's no risks that are going to crystallize for our members.
Great. Thanks so much for clarifying that. And then obviously Smart is a technology platform first and foremost. We've talked with your colleague Eve about the Keystone platform, how it enables all of that. So what I'm interested to do now is to really understand how, what that enables, because obviously technology is great, but what we want to figure out is how it delivers better outcome. And also your approach to innovation. So there's two different questions here. There's the tech, and then there's the innovation, which can be financial innovation, financial engineering, and stuff like that. But perhaps you can reflect on, well, you're dealing with multiple pensions at Mercer. What's different in the approach of Smart? What does it enable?
We built our technology from scratch about 10 years ago now. Whereas a lot of the pensions industry was built in the kind of 70s, 80s, 90s and runs off technology from then and hasn't been massively updated because it's vast and complex and expensive to really update it. What that means in practice is that members have a much better experience a lot of times. So it's much more akin to how someone deals with a open banking platform or one of the more forward-thinking banking platforms like a Monzo or Revolut or those kind of guys. We put ourselves in that space, but for pensions. So everything is in their pocket. They can see their current fund values, they can make investment changes, they can look at all sorts of research in their pocket. Similar to good ISA providers and savings providers, we're in that space rather than a real traditional pensions provider. The other side of that is really that technology for us is really efficient to run and cheaper to run. So our cost base is quite low. The technology that we run is a lot more efficient. So we can spend a lot more on investments. So, if you look at our investment portfolio, we've got things like private credit, active impact, green bonds, biodiversity, etc. In a world of pensions where there's a lot of focus on cost and passive investment, we've been able to tilt that slightly and invest in more active, interesting and private markets investments. And that in itself just leads to much better outcomes for members. So they're much more engaged. They can do a lot more in their pocket with their pensions and they get, we think, a better investment solution as well. So it's win-win, we think.
Yeah, no, this is very interesting, and I guess Monzo is a good comparison because people know it, or Starlink, etc. And there's this whole debate about the core banking that has to be modernized, etc. But you shouldn't worry about shameless plugs because, in fact, what we're trying to figure out is the evolution of the ecosystem. And just like we see in banking, I think the traditional banks are innovating as well, pushed by that, right? And I think that's a good outcome for everyone, ultimately. You touched upon that, but I saw a previous interview where you talked about zero cost equity. I was also interested in talking about this. So obviously, technology enables you to do more of that, I guess, because otherwise, well, there's a lot of cumbersome, any change in the pension fund that's built on whatever, typically 50-year-old system will be cumbersome. You need flexibility. But how do you approach, well, let's call this, innovation on the investment side? And there's different things there. There's these derivatives, there's new asset classes. So maybe it's a 2 or 3 questions, but we can start with
Yeah. I think a lot of this comes out of the fact that we're fintech at heart. So we're not a big insurer. We're not a big consulting firm. We come from the space of break things rather than stick with the status quo. And part of the reason is we have to do that, right? We have to compete with the much larger pension providers that are much more established in the UK, and we have to stand out and be different. And part of that's our tech, part of that is our investments. So you mentioned the zero cost equity. So we worked with JP Morgan in particular to build a passive equity solution, uses a completely custom benchmark that we've built and provides exposure to that in the same way that you would get through a passive equity fund, but it's at zero cost because of the derivatives used. It's a total return swap underneath the bonnet. That, of course, increases into some complexity in some places because it's now a derivative structure rather than a standard fund. But we can manage that. We've got the governance in place, and we picked a really strong platform. We use an investment platform called Mobius Life to manage a lot of the heavy lifting on that as well. So we can be super flexible and agile when it comes to investments, and we can move quickly. We weren't the first to do this, but one of the first to do this at real scale and do it with a real good custom index with a huge bank. So yeah, it's a kind of mindset thing we think about in terms of investment innovation.
Yeah, no, that's really interesting. It happens that I used to work with James Finch from Mobius Life, and those TRS. We don't want to go into the details of that, but I think what's really interesting is how, as a tech platform, where you have tech at your core, the approach to partnerships and all that, I think is really interesting. And as I mentioned in the beginning, you started your career when I finished my career in the investment industry, or at least I'm still involved, but not directly. And one of the reasons why I stopped is because I was seeing a lot of financial innovation, which was, well, let's say financial engineering, and, very much driven by how much margin we should take, which obviously is not going to change. But it makes me positive to see, yes, financial innovation is used in a very, which eventually that's the way it's always going to be, but is really used in a positive way. And how I think also your innovative approach enables you to really harness all these new possibilities. And I guess that's kind of loops the the tech side with the innovation on the everyday side.
Yeah, I mean, pensions has historically been a bit of a slow-moving beast when it comes to innovation. We get a reasonable amount of innovation in the kind of defined benefit space with derivatives, and that's worked quite well. But defined contribution's been a bit slower to kind of see the real movement in that space. So as you say, this stuff's been going on for decades now in terms of financial innovation, but it's only really starting to be pushed through into DC pensions at the moment. And we think that's only going to continue with private markets, more derivatives, more interesting stuff around voting, platforms, etc. So it's a really interesting space right now for innovation and investments for sure.
Yes, yes, yes. I think what would be interesting as well is to discuss about these private markets because they are all the rage right now.
Mhm.
You mentioned derivatives, and you also break things, which is move fast and break things, the motto of many startups. But that's a dangerous thing to say in the financial space. So, and I'm pretty sure you don't, we mean breaks things, but in a very regulated way, etc. So, yeah, how do you approach this? Because it's very different from an Uber where, oh, if things didn't work out, well, maybe the taxi didn't show up. Whereas for a pension fund, you've got a lot of risk management, you've got a lot of security in place. So, how do you approach this innovation and very
Yeah,
strong risk management, basically?
for sure. And when I talk about break things, it's more breaking the status quo that we've had for
Mm-hmm.
decades rather than, you know, take unnecessary risks. I mean, we're supported by a huge range of kind of safety nets and governance. So we've got the trustee board, who, as I say, are all independent, huge experience in this space, particularly in derivatives as well. Consultants that we use have got huge experience in the space, and we've got specialist consultants in place for this. This type of stuff has been done for decades now as well. So it's not a particularly complex for those who've been in it, but it's quite complex for those who are just new to it. So that's, we don't try and explain this to our members in real detailed terms because they don't need to know
Sure.
the details. We set out the risks of it, obviously, but ultimately it's on us really to manage those. So lots of systems in place, lots of experience learned from other parts of the market, other asset owners. But also, we work with some of the biggest institutions in the world, like JP Morgan are the other side of this for us. And they've got, again, years and years of experience, huge capital reserving, backing, and we pick them for a reason that they're the best at what they do. So yeah, lots of reasons why this stuff doesn't go wrong, hopefully.
That brings me back to also one of the references I constantly use in this podcast, which is Schiller, a Nobel Prize winner, who talks a lot about finance for the good society. And also he talks about financial innovations. He's got a great course, which is free. But ultimately, finance is a technology that you learn to use. And technology is a bit confusing, but basically having the ability to use derivatives with the right risk management in place is, I think it's exactly an example of that, how to make it happen.
Mhm.
But moving up from that, we didn't talk so much about innovation in asset allocation. And you did mention that you have now access to things like private assets in particular. So can you tell us a bit more about that? How do you look at it from an asset allocation perspective, from an implementation perspective?
Sure. Yeah, and just to note, a lot of the things we talked about so far, technology, the synthetic equity, derivatives, that kind of stuff, really paved the way for a lot of this space. So we're struggling a bit in the DC space to find particularly the cost budget to do private markets because we all know this doesn't come cheap, and particularly if you want the best managers, it really doesn't come cheap. So that's why we've done these things to kind of allow us the headroom to do it. We've had private credit since 2021, so one of the first commercial master trusts in the UK pension providers to do that. We've selected a renewable infrastructure and a private equity manager now as well. So we're going to have 15% into private markets in our default. This isn't a high cost version. This isn't a special fund that people have to select. This is our flagship kind of go to market offering. Um, the reasons we can do that is the cost savings I've mentioned. The platform with Mobius has been great at opening up doors. They're not super constrained around things like permitted links, and I really won't bore the listenership with details around permitted links and FCA COBS rules, but that really does play a big part into what we can do in this industry. Um, and again, finding the best managers in this space, so private equity, fund of funds, we don't think we've got the expertise right now to be picking individual vintages, individual venture capital managers, for example. So we've picked a really strong fund of funds manager in this space, and they've got access to some of the greatest VC managers on earth. Therefore, we can give millions of people in the UK access to those managers they wouldn't typically have. And then things like infrastructure is the other piece of that puzzle. We've got a heavy focus in that investment on renewable infrastructure, particularly renewable infrastructure in the UK. We know this is quite an up and down market sometimes, and it goes through peaks and troughs, particularly of engagement and interest from governments and individuals and that sort of thing. And ESG in itself goes through the same peaks and troughs. We think there's a huge gap here for building good renewable infrastructure, particularly in the UK. And there's, we've got fund hundreds of billions of this, so we'll be a drop in the ocean of that. But we're making a start and we're opening up doors. So, members are going to see EV charging points as they walk down the street that's funded by their own pension scheme, and swimming pools that are next heat from data centers is heating swimming pools and all sorts of innovative things up and down the UK that's really tangible for members that they can see and that they built with their own money, which is just a complete different paradigm shift versus where we've been in pensions.
Super interesting. I think there's the fact of making it tangible is also a key to solving this engagement contribution problem. But I'm going to go to that. But first, just another question regarding the private assets. You said 15%. So how is that defined? Is it obviously at the trustees level, they said 15%? Well, is it 15% private assets, or is it defined in a different way because you've got infrastructure, credit, equity, and stuff like that? I'm quite interested in this process of how do you go from, I don't know, maybe no private assets to some private assets. What are the barriers to that? Because that's I think a very current topic.
Yeah, definitely. And as I said, we've dipped our toe in private assets for a few years now, so it's not the first piece of investing we've done in this space, but this is definitely a big jump forward for us and for the industry. There's a few angles that really I'd approach it. The government, and then we'll touch on this, has been pushing hard, and that's accelerated the industry thinking, and I'd say our thinking a little bit as well. We've been doing a lot of work on this for the past 2 years, but it's just sped that up a little bit. We've come from a place of, roughly 80% equities, 20% fixed income, including private credit. So we're tilting the asset allocation mix slightly by having 15% to private markets in there, but we think the returns are going to be slightly increased and the risk is going to be slightly reduced from this, even with the kind of smoothing that you get by default from private markets. So a huge amount of analysis goes into it from a member outcomes perspective. We want to give members the best chance of being able to live the life they want in retirement, and we think private markets for 30, 40 years is the way of doing that, which is why we're doing it. There's lots of considerations in there. There's things like performance fees, J curves, all the usual stuff you get with private equity. We're working with innovative managers to reduce the impact of those as much as we can, but it's always going to be there. A long process, a long allocation discussion and process analysis that goes into that. A lot of member focused thinking and analysis as well to reach that conclusion.
Right. And therefore, this was initiated by you and submitted. So basically, coming back to what we were talking about, the trustees, when you do something like that, you initiate it, some proposition, discuss with the trustees, and eventually move on to a decision. Is that how it works?
Correct. Yeah, we as the in-house CIO function effectively drive the investment thinking and the asset allocations, and the trustee will do the work needed and get the advice needed to sign that off and do the thinking. In reality, there's a lot of collaboration between us because of the expertise our trustees have and some of the investment backgrounds they have. So we don't kind of sit in a silo and then go to them with ideas at the last minute. We'll pitch stuff really early doors. We'll have blue, I know it's a cliche term, but blue sky type thinking pretty often at trustee meetings about what's in the next 3 to 5 years that we're looking at. There's always stuff kind of bubbling in the background, but yes, it's us that then formulates the ideas and takes it to them for their approval.
Sure. Yeah, we don't want to go through the full details of the process. I guess it's not a pitch where I say, hey, yes, no, on the spot. But I really like to try to understand better this whole
of course.
process. And now going back to what you said, green UK infrastructure, which I think would be music to the ears of the Chancellor, because that's very much the kind of thing she has. She's advocating, or at least suggesting, or what has come up from this conversation. But the conversation that I've had with other people, including someone from the PLSA, is that what matters really is there's a balance, but really ultimately what matters is the best for those pensioners. But you talked about an opportunity, the fact that there's a specific, perhaps, country and sector opportunity. Is this how you approach it, or is it more oh, this is something that I think people wish for.
Yeah, there's a few important caveats to this. We have the flexibility to invest globally, and with these new mandates, we still have that flexibility. So we've not constrained ourselves, and it's going to be 100% UK. We need to see the pipeline of opportunities, and that was a big part of discussions that we had with the government, that actually you need to open up the pipeline before we put money into this. Back to your point around it needs to be in the best interest of members. There is a good pipeline in a number of these assets. We found managers who've got great access to a great pipeline in particular, even if it's not super visible. Sometimes they can find deals out of nowhere. So it's about picking the right managers in the right spaces and sectors. It's an area where we want to invest in. That's why we talk a lot about the UK. We think particularly green infrastructure we're quite good at, and there's a big need to do it, and it really benefits our members and engages them, and it's tangible like we talked about. But we have to balance that with being a global investor, getting the best returns as well. You may have seen Eversheds did quite an interesting piece recently on fiduciary duty, i.e. the responsibilities to members, and their view was that actually investing in the UK provides a positive outcome to members as well. So it's not just about the return. If you can benefit them directly by investing in local communities and local infrastructure, etc., but that balances things a little bit. There's still a lot of work and thinking to get that balance right, of course, but that's a similar view that we hold as well. So yeah, we will be overweight the UK. Our starting point is the kind of market cap weighting of the UK, but we will go slightly overweight because of all of the reasons I've just said, but we still can tone that up and down and flex on that when we need to.
Yeah, no, that's really interesting. So you have a global market cap point of view. So I don't know how much the UK is fearing that, but not a lot. And you decide to overweight. It's a very nuanced approach as far as I can see, because indeed, well, I'm sitting in Brighton and I pretty much see the windmills that bring the electricity to my house. It's relatable and I can understand the benefits. And there's something, I mean, obviously, people don't want to compromise on the returns, but there's something beyond
Mm-hmm.
the returns, right? Maybe it's like a cleaner environment, not just the pension returns, like a cleaner environment, whatever benefits from everyday life. So it's a really, I mean, we're not going to fully solve this, but now I understand from what you said, all the things that come into play and the nuance, and also the role of the government, because again, that refers to my conversation with the PLSA. It's not like the government can totally pull the levers and say, hey, this is how you're going to invest. There's really this conversation, discussion, negotiation that's taking place. And it seems to be happening in a very positive way. But I feel like from what I gathered from this announcement from the government, the reaction from the pension industry, it seems to be evolving in the right way. Is that your
Agreed.
approach as well?
Yeah, I think so. And as I said, it's been something we've been looking at for a number of years. So we're probably in a slightly different space to some providers where this is a bit more of an uncomfortable change for them. But the conversations with government have been pretty pragmatic so far. So one of it's not directly linked to the private markets, but one of the things they're going to announce is around scale tests. So you have to be of a certain size to function or to exist in this market. I think what they've compromised on is that if you've got really interesting, innovative providers in the market that are growing quickly, then there should definitely be a place for them as well. So, they started very firm on 25 billion, 25 to 50 billion had to be, but actually they rode that back a bit and said, look, we don't want to compromise on innovation and interesting startups in the UK in this space. So it's been a discussion. It's been quite brutal and honest at points, and it's been a negotiation, but we think the government's listened. The wording that's due to be announced on the new Mansion House Accord is quite pragmatic and actually puts quite a lot of responsibility back onto the UK government to find pipeline and opportunities for pension funds. And reduces that burden on pension schemes really because it's voluntary and it needs the government to do a lot. So it's been a good discussion today.
Yeah, this is interesting. Maybe it's from a French perspective where I feel like we're not so much used to that. Back and forth and discussions before that. I feel like it's it's a good example of governance, I guess. Going back as well to this tangibility and the fact that, well, maybe not everyone sees the windmills. How much people understand about what is in their pension and how much do they care about and how much, if there's any feedback or perceived feedback, does it influence your decision? Because obviously
Yeah,
they don't decide, right? It's the trustees. So
they
how
don't.
does that
Yeah,
vary?
they don't decide, but it is their money at the end of the day. So we do survey them quite regularly. We do mini nudges and questionnaires and bits. For example, we asked them about tobacco investments recently. I think maybe it's slightly changed in the last few years, but 10, 15 years ago, it's probably quite a controversial thing to say if you remove tobacco from a portfolio, because people would say it's freedom of, they've got free will, people can smoke if they want to, and it's legal. We ask members those sorts of questions. Do you want tobacco investments in your pension? And most people will say no these days because of the way the culture shifts. So we do give them a voice. Obviously, the trustee has ultimate responsibility and decides what's best for everyone, but we do give them some input. But yeah, we understand that some of this can be quite controversial as well, particularly around, wind farms, solar farms. There's environmental issues, there's political issues, there's not in my back garden type people. So the way we try and think about it is kind of take them on the journey with us and engage and get their input and feedback. And we don't try and preach to them and say, we know everything, this is the right way forward. We actually get them and say, look, what's the issue here? Did you know X, Y, Z? So, for example, with wind farms, if we said, look, if there's wind farms built in your local area, then you can get money off your electricity bills when the wind's blowing type thing. And most people pretty quickly, once they're 30, 40, 50 pounds a month, because of something their pension is doing indirectly, then they're a lot more on board rather than us just saying, we're going to build wind farms in your back garden type thing. So it's all about bringing them on the journey. And I think the industry has come a long way in the last few years on that.
And what I see now, I see smart pension as a proponent of let's call it sustainable investing. There's a lot of terms there, ESG, etc. But I would like also to submit a question that I had, or a suggestion that I had from another guest, Alex Edmonds, who has written a book like Grow the Pie and is clearly an advocate of sustainable investing. But he's also written a paper saying, the paper is called The End of ESG. And if I try to summarize it without cutting too many cords, I would say it's this: the problem is these short-term ESG metrics that are detrimental to the long-term view that matters, etc. So I was wondering, what do you think about that?
Firstly, I do follow Alex and I love his work. I think he's bringing quite a refreshing aspect to a number of areas in finance. I think he's just super smart, obviously. I would agree. I think, obviously, the end of ESG is quite a headline that grabs the attention. I think some aspects of ESG have been rowed back a little bit on in the past couple of years, for sure. And I think some of that's probably necessary, if I'm being honest with you, because it was forcing behaviours that weren't great for investors or for governments and regulators who have causing greenwashing. It was causing people to talk about things they weren't necessarily doing. It was causing kind of a lot of noise rather than actually doing anything underneath the bonnet. When we think about ESG, it's that long-term focus. So if I had to summarize our view on ESG, it's investing in companies that are going to be here in 40 years' time. We don't think that, for example, a lot of the oil and gas companies are going to be here in 40 years' time unless they change their business models, for example. Particularly in Europe, that might change in the US, but if we're talking European oil and gas companies, they're not going to be here in the same format. So there's huge business risks to them. We're seeing that with BP and others at the moment. Therefore, we won't invest in them until we can see a viable way forward for them as a business. And a lot of them don't have viable way forwards. They don't have good transition journeys and plans and ways of dealing with stranded assets, changing pipelines to deal with different types of renewable energies, for example. So that's the way we see ESG is about investing for 40, 50 years time, rather than absolutely kind of blitzing everything that we do using short-term metrics and ratings and completely transforming our portfolio. That's not really how we approach it. So yeah, I'd agree with him to some extent. The ESG has been overblown and it probably needed to come back a little bit. But actually, the way we think about it and the way I think he thinks about it is much longer term.
No, absolutely. Indeed, it's exactly that. It's long-termism and also not just metrics, but judgment and thinking deeply about stuff.
Yeah, the really interesting one that we're coming up against at the moment is defence companies. We've always been out of controversial weapons because I don't think anyone sees a place for landmine producers or cluster munitions or white phosphorus, all those types of companies that just cause completely inhumane outcomes. But actually, we've had a lot of member engagement at the moment about we should be investing in defence, and we should be investing in protecting the UK because we obviously most of our members, or almost all our members in the UK, for example, we don't completely exclude defence companies. We've got some small holdings in them, but they tend to be low holdings because of that ESG focus. So we're doing a lot of work right now as to what the future holds for our defence investing. And I think that's a really interesting discussion in the industry with lots of different viewpoints. So yeah, we're interested to see where that goes in the industry as well.
Yes, yes. Again, this nuanced approach, this discussion approach, which I think is really interesting. And it's hard to convey, but that's why the podcast format is very helpful. We can go through this over time. But now we're running short of time. So one question that I like to ask to my guest is what I call the fantasy fintech question. You said it's fast evolving. There's been a lot of change. I mean, we've talked about years, right? You started some of that, but still in the 40-year horizon that you have, that's a lot of changes. How do you see it evolving in an ideal world? What are the investment capabilities and perception from your user base that you would ideally go for?
I think we've come a long way in our space in the last 5 to 10 years, but there's a long way to go. I'd love it if we saw individuals think about their pension as an extension of their savings that they do in their everyday life. They look at it on their phone, or quite a lot of them do. They think about their investments, they think about where they're invested, they think about tax. That's what I'd really love for our pensions to become a real just a long-term savings. And I think there's a few ways that that needs to happen, that we need to make that happen as an industry. Firstly, the technology, right? Thinking more like a Monzo or someone that's super engaging, super clean UI. It makes it really easy for people to engage with, and makes it really easy for them to do what they want to do in a few clicks. That's the first step. Actually making pensions not something that's 40 years down the lane. It's actually something 5 years down the lane. And what I mean by that is, yeah, you could take out money in 5 years' time if you needed to buy a house, for example. There's lots of discussion in the industry about using some money to put towards a house. So if we can do those sorts of things, and there's things like sidecar savings that Nest are doing, so putting a little bit of money aside so they can then take out. If we increase the flexibility massively on pensions, then it doesn't become a 40-year problem. It becomes a next 5 to 10 year problem. And actually people start looking at it properly. They start looking about how much they're putting into it, which is a double-edged sword. But we think generally that's got to be positive, and they think about where they're invested as well. So yeah, in my ideal situation, in 10, 20 years time, they'll think about it in the exact same way they think about their banking products, their savings, how they buy a house, all that kind of stuff. Pensions will just be an everyday occurrence for them.
Great, thank you. Yeah, this is quite groundbreaking because indeed we see something differently if it's totally locked or if it's, well, locked but not completely. So that's interesting. And it's also a great conclusion because it allows us to look back to the conversation with your colleague Eve, where we discussed more about this aspect of engagement, UI, policy, and stuff like that without discussing any investment. So I'm glad we managed to have this double bill from Smart Pension. And yeah, I'm just very grateful for your time and allowing us to have this deep dive in this investment world of DC and Masters Trust. Thank you so much, James. And please let us know how people can connect further and learn more about you or Smart Pension.
Yeah, please look me up on LinkedIn. Happy to take any messages, questions from anybody involved. Smart Pension website's got lots of contact details. So yeah, any way you can find us, please feel free to contact.
Yes, really noteworthy efforts from Smart Pension in terms of communicating. There's a YouTube channel, we publish articles, etc., which are very helpful from an industry perspective, but also from a pensioner perspective. So we put all those links in the description. And thank you so much, James. Enjoy the rest of your day.
Thanks, George. It's been a pleasure.